Hello, how are you doing? So today we will cover financial summary of financial instruments. We will start with the objective, and this is my outline. But let me go straight to the point: objective and scope. Most of the times, every user wants to know an answer to these three questions, and financial instrument will give the preparers the principle to answer that honestly. So, for every financial assets and liability, the question one might ask themselves is how much? The amount of future cash flows expected to be received or paid. And then you will ask yourself when, the timing, near term or long term. Then you will ask yourself the certainty. Is there credit risk? What is the probability of liquidity risk? What is the probability of liquidity risk? So in practice, we have receivables and payables. For example, receivables will patients or tenants pay. Liabilities, you look at loans or revolving borrowers, will they repay? Guarantees, what's the probability of a call? So where Ipsas applies. In the public sector, there are receivables, staff loans, revolving, all those I have mentioned, borrowing, financial guarantees, below market loan. So that is where it applies. But someone might ask and say, financial instruments only applies to instruments like complex instruments like derivatives. The answer is no. Ipsas 41 applies to any entity that has receivables, payables, loans, or guarantees. Virtually, or every public sector entity that prepares financial statements. So, these financial instruments, assets and liabilities. What is a financial instrument? A financial instrument is a contract. Yes, a contract. A contract is an agreement between two or more people that creates a financial asset for one entity and a financial liability or equity instrument for another. So these are the examples. For example, student loan. Student loan, for the entity that's giving out, it is a receivable. For the person who is receiving, it is a liability. Supplier invoice. For the supplier, it is receivable in their books. But for the person who received, the client, it is a trade payable in their books. Government bond. It is an investment for someone and a bond liability for another person. Financial guarantee. There is a protection right for someone and a guarantee liability for another person. For example, this question, a public entity buys goods worth 8 million on credit. The supplier issues an invoice payable after 60 days. Is this a financial instrument? There is someone has supplied goods worth 8 million on credit. So, and then again, the supplier has already issued an invoice, but payable after 60 days. Is this a financial instrument? Yes. The answer is yes. The supplier has contractual rights to receive cash and a financial asset. The entity has a contractual obligation to pay cash, a financial liability. One contract, two sides. So if you want to ask yourself, is this is this a financial asset? Does one party have a right to receive cash? Does another party have an obligation to send the same cash? If the answer is yes, then then you apply Ipsas 41. You apply Ipsas 41. So a financial asset. A financial asset is a contractual right. It is right. There is right and obligation. So for asset, it is right to receive cash or another financial asset. Example, cash at bank, receivables, staff loan, revolving funds, treasury bills, bonds held as investment. So this is a question you also ask yourself. A public hospital invoices patients currency unit 5 million for services delivered payable within 30 days. So, what is the hospital position? The hospital has a receivable. The hospital has a financial asset. From the moment the contractual right arises, once recognized, Ipsas 41 governs impairment and the recognition. So the moment you debit receivable and credit revenue, then what Ipsas 41 governs is on the side of impairment. This one is covered under Ipsas 47. Revenue is covered under Ipsas 47. Okay, financial liability. A financial liability is a contractual obligation. The other one was right. Obligation to pay cash or deliver another financial asset. Example, trade payables, borrowing, bond liabilities, financial guarantee, below market, loan commitment. This is a question. A state corporation receives currency unit 100 million from a bank under 5-year loan. What's recorded? When you receive a loan, is it a revenue? The answer is no. It is not a revenue. But in the old cash, we used to debit bank and credit. We used to debit bank and credit revenue. In the cash basis account, that's what most probably what you used to do. But currently, under accrual basis, we will debit bank and credit a liability. So the loan received is no longer revenue. So we need to replace our thinking. Cash arrived with an obligation to repay. Revenue only arises where resources are received without an obligation to return them. So, what is the scope, inclusion and exclusion? These are all what it covers. It covers receivable, it covers payables, it covers staff and public loans, public fund loans, borrowing and bond liabilities, financial guarantees. When you guarantee someone that if they don't pay, you will pay on their behalf. Certain loan commitments where government commits farmers, for example, that they will give them a loan. Such commitments, contracts that can be settled in net cash, those hedging and derivatives. So items handled by other Ipsases, those are the exceptions. For example, interest in controlled entities, where, for example, where you are the parent and then there is the subsidiary, the parent and then there is the subsidiary. Except for derivatives, it is excluded. This one, Ipsas 34 and 35 governs consolidated accounts and separate financial statement, associate and joint ventures. This one is Ipsas 36. It is excluded from Ipsas 41 entirely because we use what we call equity method, and we know it talks about significant influence, which I don't want to discuss today, but it's a way of calculating those in the books of the holders of such those associates and joint ventures. So leases, Ipsas 43, lease receivable. So once lease becomes receivable, the impairment and lease liabilities, the recognition are covered under this Ipsas 41. Employees' benefit is excluded entirely. Surface concession arrangements, for example, the expressway you see, it is under service concession. There is the financial liability model items. So Ipsas 41 covers the derecognition part. Revenue receivable under Ipsas 41. The receivables is covered under 47, but the impairment, once receivable exists, is applied under Ipsas 41. Provision stroke contingencies under Ipsas 19. Reimbursement rights is excluded under this Ipsas 41, but we have included, or this Ipsas 41 includes financial guarantees. Once an item has been recognized as a financial asset or liability under whatever standard first applies, then Ipsas 41 governs classification, measurement, impairment, and derecognition most of the times, unless those excluded in those other Ipsases. So loan commitment within this scope. The loan commitment can either be a loan type where it is designated fair value through surplus. And this we will go through when we are talking about classification. So designated through fair value through surplus or deficit. So why Ipsas 41 applies? Because entity has chosen to measure it at fair value. Then settlable net in cash. Net in cash. The economic substance equivalent to a financial instrument where you enter into a contract to buy fuel, for example, at a future date at a certain price. So the net settlable amounts in net cash in those contracts, we look at the economic substance equivalent. We say the economic substance in those contracts is equivalent to financial instruments. Commitment to lend below market rate. A present obligation to deliver a policy benefit analysis before cash moves out. So imagine under this Ipsas, once you commit, and it is a legal commitment, it is something that is legally binding and you have committed yourself, then that becomes a present obligation to deliver that benefit. So, and it is recognized even if cash doesn't move out immediately. So first you recognize in your books. So, initial recognition. How do we recognize initially? A financial asset and a financial liability is recognized when and only when the entity becomes party to the contractual provisions of the instrument. Suppose the entity is not party to that contract, then it won't recognize. But if it is party, then it will recognize. So what are we recognizing? Suppose you have given, for example, something is in the process of procurement, but it's not yet. Someone has not even been given, or the process is not complete. Will you recognize in your books? No. So once goods are received and a payable exists, there is a performance obligation. Then recognize, but do not recognize once the budget has been approved or there is a budget line. No, you recognize when goods are received and a payable exists. A receivable arises from a contractual right to cash. Internal memo or management decision is not or won't be recognized. A loan is advanced or drawn, recognized. Procurement plan or intention to borrow. If there is intention, you have an intention to borrow, why will you recognize? A financial guarantee contract is issued. Cabinet or board approval without binding contract. So all this you won't recognize. Any verbal agreement, there must be something that is legal. A below market loan commitment within Ipsas 41. So these are some of the areas that are gray, which we need to look at in our future iterations. So a below market loan commitment within Ipsas 41 is met. So there is regular way purchase. So we can measure when recognizing these financial assets and financial liabilities, we can either use the trade debt or the settlement debt. The trade debt is the contract debt when the entity commits to buy. And most of the times, this is what we do when the entity commits to buy. Asset is on the books even if settlement falls after year end. Okay, settlement debt accounting. In this way, on the debt accounting is physically delivered and paid. Like for example, you have received the money from pawn, the settlement debt. Only assets actually delivered before year. So by the way, this doesn't involve receivables and payables. It involves other financial assets, the normal financial assets like bond, say for example, bond. For clarification, for assets measured at amortized cost, using settlement debt, please note, the asset is recognized initially at its fair value on the trade debt. That's what paragraph 59 says. The policy must be applied. Whichever of these two policies you apply, you must apply it within each category of financial assets. Within each category of financial assets. So this is the part which is very interesting. Classification of financial assets. We look at two tests. We look at two tests. It is determined or determines how a financial asset is measured. How a financial asset is measured. For example, let me take you back a little bit. When you buy, for example, bond, we have two people. We have investor and the issuer. For example, National Treasury is the issuer. The investor might be you. So you are the investor, for example. You are the investor. And the bond is 2 million. The bond is 2 million. For example, this is an example. Treasury needs more than 2 million, but let us say it's 2 million. So you have given Treasury 2 million. So what happens in the books of Treasury? They debit their bank 2 million, and they credit liability 2 million. So as that is the initial recognition. As this continues, there is something we recognize in our books. So if we were using, say, fair value, and this value keeps increasing or decreasing, how do we recognize? So the classification we are talking about is how to recognize. Like if there is an increase in this or a decrease in this, how do we recognize? One way is amortization. One way is amortization. The other way is we normally use fair value through surplus or deficit. Another way is fair value through net assets. Fair value through net assets. So we normally use these three most of the times. So what this classification tells you, there are decision tests which you need to do. And this is the first decision is, how does the entity manage this portfolio? So you're looking at the management or the business model. How does the entity manage this portfolio? So this determines whether if the aim is to collect contractual cash flows, or for trade, or for sale. You look at, am I selling this? Am I holding it to sell? Am I holding it to collect cash flows? Then the other one is SPPI test. Solely principal, payment, and interest. Principal, payment, and interest. What does this mean? Like for example, bond. Let us just look at an example like loan. Most of the times loan are held for solely principal, payment, and interest. You have gone to the bank, you have borrowed loan, you are given a certain amount. What does the bank expect? The bank expects that you pay him or her or the bank an amount that they have given you in form of principal and interest. So what this SPPI talks about is just that, the principal and interest. So is it held for principal and interest? And most of the times that principal and interest is based on the closing balances against the interest. So unagonga to closing balance times interest, and then you pay first you pay the interest, and then you pay the principal, and that is the SPPI test. But if there is something related to profit, something that fluctuates, then it fails the test. Whether the cash flow matches a basic lending arrangement. So those are the two tests. So classification is not just a theory exercise with no specific practical consequences. Classification controls the carrying amount, where gain and losses appear, and which impairment model applies. Okay, the SPPA test explained. SPPA solely payments of principal and interest. The question is, does the interest behave? Does the instrument behave like a normal lending arrangement? The borrower repays the amount lent, principal, and pays interest that covers time value of money, credit risk, liquidity risk, and normal lending margin. Nothing more. A staff loan of currency unit 1 million, repayable over 4 years, 5% interest, repayment is fixed, not linked to profit or share price. Does it pass SPPI? Yes. Because what what the giver of this loan is stuff. So what you are giving is the cash flow are principal and interest only. No return depends on any other thing other than time and credit risk. So SPPI test is satisfied. Okay, when can we say SPPI fails? Solely principal, payment, and interest. When can we say it fails? Okay, feature number one, return linked to borrower profit. For example, if the borrower loses or gains a certain amount and that return is linked to that and not a fixed interest, then we say it has failed. If it is based on performance, not basic lending, it has failed. Return linked to share price or equity index, like an equity investment, not a loan. If it is share price, or equity index, then we can say that is an equity investment and not a loan. Return linked to commodity price. Cash flow depends on market movement. So there is no interest factor in that. So inverse floating interest does not represent normal time value of money. Does not what we can say, an inverse floater is a type of bond or debt whose coupon rate moves in the opposite direction of benchmark, such as LIBOR or EU LIBOR. As market interest rates, the coupon rate payment on a vice so decreases. So this is an inverse. The way interest moves, this one moves opposite of that. So it does not represent normal time value of money. Usage-based return. Usage-based return that depends on asset usage, not principal and interest. Okay. Question. Government B buys subscription rights in International Development Bank A at currency 1,000 each. Government B can sell them back, but the bank is not required to pay dividend. So you classify. So this automatically fails SPPI test because principal and interest. Just observe, is this like a loan? No, the rights do not qualify. The rights do not qualify for the equity selection and cash flows and not solely principal and interest. Classify at fair value through surplus or deficit. Okay, so this is not an equity. Subscription rights, government can sell them back, but the bank is not required to pay dividends. Most of the times, what we know on equity instrument is you get dividends. You get dividends. So classification decision. So debt type, if it is held to collect. If it is held to collect, you use amortized cost. For example, a state department gives a star car loan of 1 million to an officer repayable monthly. So this one passes SPPI test and the business decision is held to collect. So use amortized cost. Debt type is held to collect and also sell. Here we will use fair value net assets. Fair value net assets. Fair value through net assets. So a government investment funds buys treasury bonds. It collects interest but may sell some. So collect interest but may sell. This one also passes SPPI test but may sell before maturity. So the aim is to collect interest, but also if it so wishes, so the objective is both to collect interest and principal, also sells when necessary. SPPI passes because the treasury bonds normally pay principal and interest, and therefore you use fair value through net assets. Please note, look at this. The first one to collect, the second one both to collect, and then one is amortized, the other one is fair value. And by the way, most of these things, how even if you do it wrongly, there is high chance, even other than amortized cost, there is high chance others the books will balance. The books will balance, but because of the way Ipsas 41 guides, then the classification might be wrong. Debt type managed at fair value or trading. So the aim is for trading or you use fair value. Fair value. So as the name describes, you use fair value through surplus or deficit. So the rest of this you can use fair value through surplus or deficit. Debt type fails SPPI test. So if it is a debt type, account gives a loan to a company but repayment will increase or decrease. If it fails, then you use fair value through surplus or deficit. Remember, we were talking about failing SPPI test, and that is one of the indicators on how to select either of the first two. Okay, equity. So equity, this one normally fails SPPI test because it is equity, and equity most of the times you don't hold it to collect principal and payment, and therefore you apply fair value through surplus or deficit. But equity not held for trading, you are allowed to use fair value through. So if you elect once, you cannot recycle. If once you have elected that, you cannot keep changing. You stick to fair value through net assets, and that's how we do the classification. So fair value through net assets election for equity instruments. Paragraph 42 provides that equity instrument default to fair value through surplus. However, an entity may make an irrevocable election at initial recognition to present fair value changes in net assets equity instead. This election is available only for equity instruments that are not held for trading. So, when to elect at initial recognition, not in between, and you can never reverse it. What qualifies? Any equity instrument not held for trading, not contingent consideration, fair value changes. All changes go to net assets stroke equity, never recycled to surplus or deficit. Dividend still recognized in surplus or deficit. So the dividend you earn from this, the income you get in form of dividends, you take it to surplus or deficit. But the fair value changes, the changes to the fair value, it will go to net assets. Without election, every market movement in equity holding hits the surplus or deficit line. This is where we call other gain, or losses. This is where we call other gain or losses. Classification of financial liabilities. While financial assets have three possible measurement categories, financial liabilities has a much simpler. All financial liabilities, majority of them, are measured at amortized cost after initial recognition, unless one of the five specific exceptions apply. One of the five specific exemptions apply. Fair value through surplus or deficit, if it is derivative and held for trading, or if the designation is fair value through net assets. This paragraph 45 subsequently measured at fair value gains and losses to surplus or deficit or net assets for on credit risk. See section 16.3. Transfer of assets does not qualify for the recognition, measured in accordance with paragraph 26 and continuing involvement rules. Financial guarantee contracts, higher of ECL, loss allowance, or initial fair value less cumulative revenue recognized. Below market loan commitments, higher of ECL. So this is how you treat it. Contingent consideration at fair value changes to surplus or deficit. Changes surplus or deficit. Okay. So exceptions, for most exception is Ipsas 40 combination contingent in an Ipsas 40 for most public entities. The only exception encountered in practice are C, financial guarantees, and below market both of which use the higher of rule described in section 9 and 10. All other liabilities, bond, loans, payable overdraft, stay at amortized cost. So financial liabilities are just like financial multiple measurement categories depending on income. Financial liabilities have one default measurement category, amortized cost. There are only 5 exceptions, and most public entities will encounter at most 2 of them. Initial measurement and transaction cost. The starting point of fair value. The starting point of fair value. So, instrument, financial assets and liabilities. Not at fair value. How do we measure? Not at fair value less cost to fair value through surplus. Fair value plus transaction cost directly attributable to acquisition or issue. So those we normally measure at amortization. Those we normally amortize. So we use the fair value assets and financial assets, financial assets and liability at fair value through surplus, fair value only. Transaction costs are expense. Short-term receivables, these common receivables, transaction consideration. So transaction cost, what can we call transaction cost? Because you are hearing here, there is something we say transaction cost. Legal fees on issuing a bond. How do we treat them? If the transaction cost is legal fees, deduct from initial carrying amount. If you are using amortized cost. But if you are using fair value through surplus or deficit, you expense immediately. You expense immediately. Broker commission on buying investment. If you are using amortized cost, you add it to initial carrying amount. If you are using fair value through, you expense. So if you look at this most of the times, any transaction cost related to fair value through surplus or deficit, you expense immediately. If it is amortized cost or net assets, fair value through net assets, you either you follow this, you follow except general overheads. So what is this? What is this we call fair value through net assets, fair value through surplus or deficit? I think we will be talking about this, but once you understand what this is, it is a way of measuring those financial assets and financial liabilities. And as I do the examples, you will understand more. So, the one difference. When fair value differs from transaction cost, what are you supposed to do? When fair value, and how can it be different? When fair value initial recognition differs from the transaction price, the difference is recognized immediately. Yes, the most common public sector case is concessionary loans. Imagine I give you a loan of say 10 million with 0% interest. In terms of, if we do in terms of calculation, and I give you this for 2 years, time value of money. Money today is not equivalent to money tomorrow, which means this person hasn't given you this loan at a fair value of 10 million. That person has given you at below the market rate. The balance or the difference, this person or what you could have been charged as interest, he has given you for free. He has given, that is an expense in his book, so that the interest part, the interest factor or time value factor of that money after 2 years is what you will pay him back, the 10 million. So we will understand effective interest and method and amortization cost. So what is the what the method does? The effective interest method spreads the finance income or cost over the useful life of an instrument so that a constant rate is applied to the carrying amount each period. It ensures that any discount or premium at issue is recognized as part of the return over the full term, not as a lump sum. Yes, for example, Treasury gets a bond of 500 million, for example. The issuer has issued for 50. For 50. The issuer has given for 50. Treasury got in their bank account for 50. This person paid for 50, both of them, but the loan value is 500. there is transaction cost. Each party has a transaction cost. So this one, the transaction cost, let us say 450 plus 20, we add back. It becomes the issuer 470. But for the receiver, let us say transaction cost here is 30, 20. So here, what he received in his bank account is 430. So in their books, they will start with this 430. And the expectation is they should arrive at 450. And in the books of the investor, they started with 470. And both of them are expected to end up with 500. So how do we do it? Someone has started with 430 and someone has started with 470. Can those rates, if you are equating to 500 after 5 years, can those interest rates be the same? The answer is no. If the answer is no, then you look for that rate, and I will show you how to get that rate in our next examples. For example, a public entity issues a 5-year bond. A public entity issues a 5-year bond, okay, with a principal of 5 million, a coupon rate of 6% per year. If you multiply 6 times 5 million, you get this 300,000. So the proceeds, I don't want, this one is already given, 4851 200, issued at a discount. So it was issued at a discount. So market yield is 7%. So the EIR is 7%. So now, suppose you are not given this 7%. How do you calculate? So what is the cash payment every year? How many is the number of years? Let us solve this one. It is very interesting. I will show you how to solve it. So let us do this. Just do this. Say what you were given initially, okay, sorry, this is the time you tell Excel sorry. So initially 4851 200. So let me start with that one, 4851. So minus 4851 200. So you started, or you received that money. Someone has given you that money. Let us put it as negative. The cash flow every month is 300,000. 1, 2, 3. So let us take this for 5 periods, because it is 5 years, 5 periods, and make it positive. So 1, 2, 3, 4, 5. And then on the final year, the assumption is you are not just paying 300,000, you are paying 5,300,000. Now we need to get the 7%. How can we get it? What we will use a formula called IRR, internal rate of return, is equal to what we can say, internal rate of return, comma, it tells you cash flow amounts. So I don't want to guess the rate case. Excel is so intelligent that it will give you the rates. So ours is just to type IRR and then the cash flow amounts. So close the bracket. So I don't know why this one has behaved that way. My Excel is misbehaving. So my Excel is misbehaving. So let me start from here. I pick it here, then delete this, close the bracket. So you can see that 7%, that is the magical, that 7%. So if you look at that one, it is 7%. And by the way, this is the 7%. So if in a situation you don't have this IRR and you know the cash flows, you just calculate backward and get. So what did we say? The effective interest method spreads the finance income or cost over the life of the, so that the constant to the carrying amount each period. It ensures that any discount or premium issued is as part of. So the internal rate of return that equates the IRR, that equates the initial carrying amount of all future cash flows. That's what IRR typically is. So year one, this is what happens. We will start with the opening 48, 51, 200. We will take this 7% multiply by this 7% of 48, 51. You will get 339. Then if you look at this, 339 minus 300, it is about 39. So the closing balance is, so what normally happens is carrying amount plus interest minus cash flow should give you the closing balance, should give you the closing balance. I will share these notes, I know, but it is just opening plus interest minus cash flow will give you. So imagine this is how we amortize loans, and this is the same calculations even when you look at your, if you have any loan, when you look at your bank statement, this is what you see. If you are dealing with mortgage, this is what you see. If you are dealing with car loan, this is what you do as you calculate for those individual loans. So what do we debit, what do we credit? We debit the finance cost and credit the bond liability, because liability, interest increases the liability. What happens? Interest increases the carrying amount. So you add interest to the carrying amount and then you minus the cash flow. So debit finance cost, credit bond liability. Debit finance cost, credit bond liability. The payment, what happens to the payment? You reduce the liability by 300,000 and also reduce your bank. So debit, bond liability, credit, bank. The finance cost 339 exceeds the cash coupon rate because the AR is applied to the carrying amount, which includes the discount being unwound. The carrying amount grows towards 5 million at maturity. So concessionary loans, this is the core idea, gift and loan at the same time. So a concessionary loan is a loan issued or received at below market terms. So it's a loan issued at below market terms. Remember, there's a time I mentioned concessionary loans. A lower rate, delay repayment, or partial forgiveness. The accounting always begins with a substance question. What portion is a real loan and what portion is something else? So, is the full amount recoverable as a loan? That's the question you ask. All of it is a loan. Measure at fair value using the market rate. If all of it is a loan, then measure at fair value using, is part of it a grant or transfer to the borrower? Split loan element at fair value, transfer element as immediate expense. Yes. Is it a contribution from owners? Part or all recognized as equity, net assets. So, is it if it is a contribution from owners, then treat it as equity. Is it below market benefit, a policy cost, recognized as social benefit expense in surplus or deficit? What it's saying is, take it to the statement of financial performance. So the loan asset is always recorded at the cash amount advance. That is wrong. Loan is not recorded at cash advance. The loan asset is measured at fair value. The gap between cash advance and fair value is the cost of the policy, a real expense that must be shown immediately. For example, the Department of Education advances current unit 250 million to qualifying student. No principal in year 1 to 3. 30% in year 4, 30% in year 5, 30% in year 6. Remaining 10% forgiven at the end of year 6. Interest is 11.5% annually. Market rate is 11%. Fair value at initial recognition. So this one is already calculated, but let us calculate. How do we get this fair value? Record the loan. record the loan. So how do we get the loan? We have given 250. The loan we have given 250. It has an interest of 11.5. So if we have given 250, how is this fair value coming to 236,989? So we do this. We say the original amount of the loan is 250,000. The original amount of the loan is 250,000. That is the original amount. The original amount is 250,000. If the original amount of the loan is 250,000, how much have we forgiven? So that we get the fair value of the unforgiven amount. And at what point are we forgiving? So when we are discounting, we normally look at year 1 is how much, year 2 is how much, year 3 is how much, year 4 is how much, year 5 is how much, year 6 is how much. Like we say, when we are doing discounting, we say is equal to present value interest factor of 1 shilling, for example, is how much? 1.1, we say 1 divided by 1, 5, 1, 5, that is 11.5%. Then power, say this one. But first, before I say the power, let me put this in brackets. Let me put in brackets because that is very important. It may distort our formula. It may distort. Now I'm getting a reference, but I know this will be solved. G33 1.15 power. Why am I getting reference? 11.5 divided by, so let me do this. Delete also that one, enter. I'm getting a ref cell. Maybe it is thinking this is not a number, it's thinking it is text. So let me convert this to a number, and I'm still getting the calculator dependency detected to resolve the iterative. So let me just use 1 power 1. Yes, power 1. This is it. So I double click power 1, then I say 2, and then I say 3, then I say 4, then I say 5, and then I say 6. So what happens is on year 6 you are forgiven 25,000, and this is the present value on year 6. So you take and multiply this times what you have forgiven. How much do you forgive? You are forgiven 25 million. So let me put here 25 million. So let me use, so 250 million minus 25 million, 250 million minus 25 million, how much are we getting? So that is it. How much are we getting? You say 250,000 minus 13,010. That's what you can see. 2 million, 2.6 million 989, 2.6 million 989, 2.6 million 989. So this is how that fair value came up. That's how this. So you record the loan at fair value, even though the market rate equals to the contractual rate. The fair value is below the principal. The gap comes from the delayed repayment and the forgiven 10%, not from interest concession. The loan is therefore, or will therefore, be recorded at fair value. So what happens when you receive cash advance? So we credit the bank with 250, we debit loan asset with, and then expense immediately this amount. You expense immediately this amount. So interest revenue on student loan. So same student loan, initial carrying amount is this, EIR is 11.5, calculate year 1 interest. So year 1 interest will be based on this. not 250 times. So this is the cash flow. This is the interest amount that was paid, and not, so cash interest received is based on 250 times the 11.5, but the interest revenue will be based on the closing balances, on the carrying amounts, on the carrying amount. So finance income is calculated on the carrying amount, currency unit 236 million, not the cash advanced. Cash received reduces the loan balance. The two amounts differ because the carrying amount is below the contractual principal. The contractual principal. Interest-free revolving fund. A revolving fund advances currency unit 10 million to beneficiary groups repayable after 1 year at 0% interest. Market rate is 12%. Record at initial recognition. Record at initial recognition. So fair value is how much? Currency unit 10 million. Currency unit 10 million. Okay, interest-free revolving fund. A revolving fund. So you have given umepeana your 10 million to benefit repayable after 1 year. So what you are repaying, you are giving 10 million and they are repaying. But then what we say, this cannot be the same. This is some of the areas where the two are differing. It cannot be the same because of time value of money. So you discount this. You say 1 divided by 1 plus r power 1. Once you get the rate, fair present value interest factor, then you multiply here and you get something like this. The difference means is an expense in your books. Okay, cash advance is 10 million. Fair value of the loan is this, concessionary expense. So that one we call it concessionary expense. So debit loan asset, debit concessionary loan, and credit bank. So below loan commitment. When an entity commits to lend at below market terms, that commitment is within Ipsas 41. A liability is recognized as the commitment debt. Yes. The liability arises before cash moves. Before any cash is disbursed, the entity has already promised to deliver a policy benefit. Waiting until disbursement to recognize the cost will understate the liabilities. So, before the planting season, the Department of Agriculture commits to make interest-free loans of currency unit 100 million to farmers, repayable before next harvest. The market rate is 1.5%. No credit impairment expected. What is the fair value of the commitment? What's the fair value of the commitment? So the fair value of the loan to be made is 100 million. The fair value of the loan to be made. So then, using the same logic, what is our answer? Okay. When the loans are granted, the department later advances the full currency unit 100,000 commitment recognized. Record the disbursement. Loan assets, debit loan commitment liability, credit cash. Okay. Interest revenue over the year, this, and then it gets back to the amount. At repayment, cash, loan asset, this. The expense was recognized at commitment. So the commitment liability is nil after disbursement. Interest revenue over the year unwinds. The discount exactly. Returning the loan to bar at repayment. Subsequent measurement of the commitment liability, measurement basis, ECL, loss allowance. If credit risk increases, ECL may exceed the initial liability. Use the higher figure. Okay. Initial amount recognizes less cumulative. This one we say if the commitment was 5 million, for example, if the commitment, the initial amount recognizes less cumulative revenue. Okay, we'll check this one. Think financial guarantees. Okay, initial amount recognizes less cumulative revenue. Okay, so this one less cumulative revenue. So this one I will check what it means. I will check what it means. Okay, I will check this one what it means. What it means. So initial amount recognize less. Initial amount, first let me confirm this one. Let me confirm it because this is something very important and I want to understand what it means. This is something I need to understand. Something that must be understood. So what does P mean? What does P mean? The unamortized balance of the original fair value. The unamortized balance, the remaining balance of the original. When the entity first makes a below market loan commitment, it recognizes a liability at fair value. Later, the liability should not remain forever. It reduces as the entity fulfills commitment or as the commitment period passes. As the commitment, initial liability revenue already or amount already released. Assume government commits to give farmers initial liabilities equal if after 1 year the entity has released because of the pattern has been provided. So you reduce what you have given. Thank you. So financial guarantees. A financial guarantee contract is one that requires the issuer to make a specified payment to reimburse the holder for a loss because of a specified debtor fails to make payments when due. In the public sector, guarantees are frequently issued at no or nominal consideration as part of economic or social policy. So, what guarantee is? A contractual promise to reimburse the lender if specified borrower defaults. For example, you are guaranteeing Yusuf that if I default today, you will pay on my behalf. National Treasury, for example, is guaranteeing your entity on that if you default, they will pay. What guarantees not? The entity on borrowing. Government doesn't take on the loan. National Treasury, for example, doesn't take the loan. A liability from the guarantor, from the debt the guarantee is issued. So, a liability for the guarantor. A contingent disclosure only. It is a real liability that must be measured and recognized. So, it is not a liability. It is a liability from the debt the guarantor is issued. A contingent disclosure only. It is a real liability that must be measured and recognized. Okay, measured at fair value initially, not the full guaranteed loan amount. So initially you measure at fair value. What is this fair value? If the loan, for example, was 200 million, is the fair value 200 million? Is the fair value 200 million? A liability equal to the face value of the guaranteed loan. What does it mean? Okay, initial recognition. Kenya, a government A guarantees a 5-year loan taken by entity C from a bank. Entity C provides a nominal consideration of 5,000. Fair value of the guarantee 5 million. How should the government record this? Government A records the guarantee liability at fair value of this. So you debit expense credit. So the fee received covers only 5,000 of the value. So what you do is the expense is 49.95. The liability is 49.95. 49 and 95. 49.95. 49.95. So if you expense this, debit expense, debit bank, and credit a liability of 5 million. Debit liability of 5 million. So how liability moves over time? There's three stages. There are three stages. After initial recognition, the guarantee liability can go three directions depending on what happens with the borrower. Depending on what happens with the borrower. Standby, no default. Standby. So the entity doesn't default, so it's standby. Entity is providing the guarantee service each year. Liability is released. So if you are provided 5 million liability, you divide by 5. So each year you will release 1 million, 1 million. So it is just standby. So you remove, like amortization, you remove from your books. Credit rises. Borrower financial position. Liability is measured at higher of the two. If you have 5 million or 4 million, and ECL is 6 million, you take the 6 million. You take the 6 million. The difference you take to you take to expense and liability. Default expected security probable payment to the lender. Liability jumps to ECL. The probability weighted expected payments. The probability weighted expected payments. The probability weighted expected payment. Question. Government A guarantees liability. Current unit 5 million for 5-year period. No expected default in year 1. Stand ready services satisfied evenly. Record year 1. So, financial liability guarantee is 1 million. Revenue is 1 million. So, a government guarantee liability is 5 million. So, no. Standby satisfied evenly. Record year 1. So, revenue release. You only debit guarantee liability 1 million, credit revenue. Do not apply straight line automatically. The pattern of release follows the pattern of guarantee service. Judgment and documentation are required when default becomes expected. For example, in year 3, C is expected to default. Lifetime ECL on the guarantee is 25,500, but current guarantee liability after 2 years is, so what you do, if you already have this 3 million, and we say the higher of the two, 25,500 is the new one, but what you will debit, the expense you will debit is 22,500 because it's just the increase. It's just the increase. So ECL loss allowance required is 25. Current, so the higher of the two, you take that one. But what you debit is expense 22,500, financial liability with that amount. The liability jumps because of the higher of. Rule now requires ECL rather than the unamortized initial fair value. This is the probability weighted expected loss on the guaranteed loss, not the full currency 50 million. 50 million. So fair value measurement when fair value is required. Fair value is required, initial measurement of all financial instruments. All assets and liabilities start at fair value, correct? Subsequent measurement. For fair value through. So if you use fair value or fair value through net assets, then fair value is required. For investment held for trading or designated at fair value. Fair value guarantees at nil or, so when the guarantee is at nil or nominal consideration, then fair value is required. Concessionary loans, revolving funds lent at 0, fair value is required. Unquoted equity instrument instead without market price, fair value is required. So valuation techniques, this is the quoted price, recent transactions, discounted cash flow, constant growth model, adjusted net assets. So all these are valuation techniques which you apply, and sometimes it's not must for you to apply these technical valuation techniques. There are, so Ipsas guides, you look at the recent price. The recent price. For example, a sovereign wealth fund buys 10 shares in entity D for currency unit 1000 in 2010. Entity D issues 10 identical new shares to another investor for 1200. Which year? 2012. 20x2. No significant change before measurement rate. Best value evidence. So, currency unit 1000 is the recent arm's length transaction price for identical shares. No fair value model needed. Okay, DCF, discounted cash flow. Government holds 5% of entity R. Enterprise value by DCF, currency unit 1121. So this DCF, you got 1121.8. So the entity value is this. Fair value of the debt is 240. We normally say asset is equal to equity minus liability. Equity plus liability. So you know the asset. The asset, let us say, is this, or the value. Then equity, we don't know, but we know the liability. So the total value of your assets minus liability will give you the equity value or the net assets. So if you hold 5% of this, 5% of this is 44.1. 44.1. Adjusted net asset method. An investment agency owns 10% of an unquoted company. Business assets currency unit 800,000. Fair value of borrowing is 250,000. Fair value of the holding is 10%. So adjusted. How do you do it? So since we know the fair value is business assets is 800. Value of business assets is 800. Fair value of the borrowings is 250. So our net equity is how much? If you hold, you just again, this one is more like the other one. This one is more. An investment agency owns 10% of business assets. Fair value of borrowings is this, value of 10% holding. So what's the difference between these two? So one, we have the enterprise value, and the enterprise value, which we measured with DCF, discounted cash flow. Discounted cash flow. Cost is not automatically fair value. No stock exchange price means we must estimate fair value using a technique. Recent transactions, DCF, adjusted net cost only acceptable where it's reasonable reason after active assessment, after active statement. Now we move to the recognition. The 4 conditions for the recognition of liabilities. Liabilities are derecognized. Sinidawa ni kulipa. Yes. So when entity pays or performs the obligation, then it is discharged from their books. For example, a loan is repaid to the lender in full. Waived. Creditor releases the entity from obligation. Lender forgives outstanding debt. Also consider Ipsas 47 for non-exchange transactions. So normally, if the debt is forgiven, what do? You debit the loan, credit revenue. If it is cancelled, contract terminated by agreement, facility cancelled maybe before drawdown, then you recognize the liability from your books. Expires. If, for example, you had a provision, you debit the provision and credit surplus and deficit. Obligation lapses by its own terms. Guarantee period ends without a call. Guarantee period ends without a call. You also do the same and reverse. Gain or loss. A state corporation has a loan liability carrying amount 10 million. The lender agrees to accept 9.2 as full and financial record the extinguishment. So the carrying amount is 10. The settlement paid is 9.2. So this one, you take it to surplus or deficit. You recognize as revenue in your books. Because if initially you had liability in your books. You had a liability in your books. So, and you are removing, if you debit liability, you credit bank, where do you debit, where do you credit? So, gain on recognition. Where a lender waives a debt as an exchange transaction, Ipsas 47 may also apply to the recognition of the resulting benefit, to the recognition of the resulting benefit, the recognition of financial assets and write-off, the recognition of financial assets and write-offs. Why the recognition of assets is more complex. Removing a financial liability requires only that the obligation is extinguished. Removing a financial asset requires answering, has the entity given up the risk and rewards of owning the asset, or does economic exposure remain? If we sell a financial asset and receive cash, it is derecognized. No, that's wrong. Legal transfer alone is not enough. The test is whether substantially all the risks and rewards of ownership have been transferred. If the seller retains material exposure through a guarantee, a repurchase obligation, or a subordinated interest, the asset stays on the books. How? We look at this. Has the entity transferred substantially all the risk and rewards? If the answer is yes, derecognize. Has the entity retained substantially all the risk and rewards? If the answer is yes, continue to recognize, no derecognition. Neither. Retained, control. Control, retained. Recognize to the extent of continuing involvement. No control, derecognize. So a loan receivable at carrying amount is sold for 520. Substantially all risk are returned, no continuing. So consideration received 520, carrying amount. So gain on a loss. Okay, write-offs. When there is no reasonable expectation of recovery, a write-off is different from ECL provision. An ECL allowance keeps the asset on the books at a net carrying amount. It is an estimate of future loss. A write-off removes the gross carrying amount entirely because the entity has no reasonable expectation of recovery. The asset or a portion of it, it is a derecognition event. An ECL allowance is like a reserve parking space. It's still there, just noted as likely absent. A write-off removes the parking space from the plan altogether. The car is not coming back. So step, accounting and carrying amount. ECL allowance recognized earlier. Debit, impairment, loss, or credit loss allowance. Gross carrying amount unchanged, net carrying amount reduced. Write-off against existing allowance, debit loss allowance, credit gross. So both gross and allowance reduced by the same amount. Net carrying amount unchanged at the point of a write-off. Write-off with no proper allowance, debit impairment loss, credit gross carrying amount. Gross carrying amount and the net carrying amount both reduces. A staff loan of currency unit 50,000 has an existing loss allowance of currency unit 30,000. The employee has left with no forward address, and the entity concludes that there is no reasonable expectation of recovery. Record the write-off. Record a write-off. After write-off, the loan no longer appears on the statement of financial performance. However, enforcement activity may continue. A subsequent cash recovery is recognized as income when received. Write-off does not release the entity from pursuing recovery. If cash is later recovered on a previously written off asset, recognize the receipt in surplus or deficit in the period of recovery. Write-off and ECL allowance are different. An allowance reduces the net carrying amount while keeping the asset on the books. Write-off removes the asset because there is any reasonable no longer any reasonable expectation of recovery. These two are distinct stages. Thank you and enjoy your